At the end of Ray Dalio's long-term debt cycle, nearly every asset class suffers, except for the hardest form of money. When fiat currencies face major devaluation and rising interest rates unwind years of cheap debt, all traditional investments come under pressure. The only way to preserve wealth is to move wealth into an asset that can't be debased, can't be printed, and isn't propped up by financial engineering. And that asset is Bitcoin. Some people will say, well, there are other assets that serve as a good inflation hedge. But realistically, at the end of the long-term debt cycle, every traditional asset has headwinds. Let me explain. First, fiat currency. By design, fiat is meant to lose value over time. When governments are forced to inflate away debt, holding cash guarantees a loss of purchasing power. It is one of the worst places to seek safety at the end of the long-term debt cycle. Second, real estate. Many see real estate as an inflation hedge, but it has serious flaws. It's a highly leveraged asset class. Most buyers put 20% down and borrow 80%, effectively going 5x long. Near zero interest rates fueled an unsustainable price surge. But as rates rise, buyers can afford less. Demand slows, and real estate appreciation becomes far more constrained relative to hard money like Bitcoin. At the end of the long-term debt cycle, real estate prices are already pushed abnormally high. Next, equities. Stock prices are deeply tied to interest rates through discounting future cash flows. When rates are low, valuations soar. But as rates rise, valuations compress, and companies relying on cheap debt face higher borrowing costs, further straining earnings. Just like real estate, cheap debt pushes equity prices abnormally high. Now fixed income. Rising rates hit bonds the hardest. Bond prices move inversely to interest rates, meaning as rates rise, bondholders see their investments lose value. Next, gold. While gold is one of Ray Dalio's preferred assets during this period, it has flaws. Bitcoin is now directly competing with gold, as seen in the inflows to Bitcoin ETFs versus gold ETFs. Bitcoin also has significantly more upside due to its smaller market size. More importantly, Bitcoin possesses superior monetary properties. It's scarcer, more portable, more durable, and more verifiable than gold. As a result, gold is likely to lose market share to Bitcoin over time. Last, Bitcoin. Unlike these traditional assets, Bitcoin has a fixed supply, and it is rarely bought with significant leverage because its extreme volatility quickly wipes out over-leveraged speculators. Even Saylor, who is known for borrowing money to buy Bitcoin, does it in a very conservative manner. MSTR targets no more than 30% leverage on their assets. This is the opposite of real estate, where it's common to use 400% leverage, 20% down, or 5x long. In a world where fiat is being debased and leverage-driven assets face headwinds under rising interest rates, Bitcoin stands alone as the hardest money. As the long-term debt cycle resets, investors face a choice: cling to assets that depend on endless credit expansion, or adopt the only asset designed to withstand monetary debasement. The future belongs to those who hold Bitcoin. Thanks for watching, everyone, and see you next time.